So friends have been asking me when I'm going to respond to the recent Fed hike of 0.75% this past Wednesday. So here it is.
There have been many comments, many questions. What does this mean for the future? What does this mean for mortgage rates? We're going to do some analyzing.
Yeah, so basically the Fed came out on Wednesday, and after a 2-day meeting, or call it a day and a half meeting, who knows, it may have only been a day, but anyway, they came out with a press release about 2:30 p.m. Eastern time on this past Wednesday, the 15th, and they basically said that the economy is still going strong and that they felt that there was a reason to raise the rates 0.75%. Now, I had recorded a video shortly beforehand, and I was kind of wondering what they would do, and had sort of said, hey, maybe they would skip over this next meeting and just kind of let time take its toll, because I kind of feel like, a lot of what the data these analysts look at really isn't real time. I mean, it's not like it's the stock market that we're looking at the tickers up to the moment of what the price is. So it requires a lot of backward looking to try and determine what's happening with the economy. And a lot of, I feel, what people are still judging prices and rates and the economic situation. And we're going to show you some really, some charts that are really going to shock you. You're going to say, wow, until you look at the history and where we are now, it's kind of hard to compare when people are just talking about things. But the interesting thing is that even with contracts of houses, people are saying that they're still seeing houses close above asking price. You got to remember, these are contracts that were signed 30 and 45 days ago. So we're kind of also looking at backward looking data to find those things out.
So what happened earlier this year is that the Fed had raised the rate 0.25% in March, and in May 0.5%. So June's 0.75 increase doubled what had already been established.
Yeah, which was right around zero at the beginning of the year. So the interest rate was zero. So all of these, home prices that you have seen as a result of interest rates being so low, I believe is a big part of that. A lot of people say, well, what does that mean for me when the Fed raises the rate? So what we'd like to do is take a look at, the mortgage rates historically. But before we do that, the Fed raising the rate really affects a lot of lending, consumer borrowing, and even company borrowing. So a lot of the major purchases that we finance, your payment's affected by the amount of interest rate. So it doesn't directly, when you see the Fed raising rates, as far as you're concerned, the way that affects you the most is when you have debt that you're financing, especially debt or that you're about to finance, because it significantly changes your payment when the interest rates rise. But the important thing is your credit card debt. So, any variable rate loans that you have can be affected as these rate hikes occur. Let's just take a look at the 30-year fixed mortgage rate, because, a lot of people, unless they look at the data, they don't really have any kind of idea of what has happened historically. But as you can see here, we were at historic lows. I mean, dating back to the early 70s, we had never seen mortgage rates as low as they were by the Fed lowering their rate to zero. And now today, where we're sitting as a aftermath of the Fed raising the rate another 0.75 point, is right around 5.78%. Now that varies. If you go to Google or mortgage calculators and you put in 30-year mortgage rates, the amount of money that you're putting down, you will see the average in a lot of the sites in the sevens. It's very easy, depending on your credit worthiness, the amount of money that you put down, because a lot of these averages are based on 20% down. So when you take away, and the fact that most people can't put 20% down, it significantly increases the amount. And what this means, guys, is, even from where people were borrowing last year, and we're going to take a look back in 2008 here in a second, because the rates today kind of predate the last time we saw these types of interest rates, mortgage rates, was in 2008. But if we just talk about the last 6 months of what you could buy a home for and mortgage rates 6 months ago, today is averaging 30 to 40% more for the same priced house 6 months ago in mortgage payments. All right, so now let's talk about the rate being the same today as it was in 2008, because since then we've really seen low interest rates. So in the second quarter of 2008, the average median home sale price was $235,300. Today, we're somewhere around $428,700. Now, what that means, guys, is if you bought, so that's a difference in $193,400 more for a median house today than it was in 2008. So when you consider the difference of $193,400 more, and you take the interest rates that they are right now, that cost, just the difference, okay, just the difference, not the total mortgage, but the difference, it costs on average about $1,132 more a month for that house today, that median priced home today, as it did in 2008 when you're talking about, the amount the median home prices increased. Now, the significance of that is that, we're wondering whether home prices are going to come down. And a lot of people are saying, hey, home prices are going to come down to the 2008 price level. I don't think they're going to go that low. No one has a crystal ball. Obviously, we're all sitting on the sidelines. I do believe that prices are going to soften, but I think somewhere around, if we looked at 2008 median prices and gave it some type of normal, rise through history, maybe even a little bit on the high side, we will see a drop down to those numbers.
Thank you so much for sharing that, because I think what we do is we kind of look at these things separate and not together. So yes, the rate right now is equivalent to what it was back in 2008, but we really need to, see the difference in the median sales price of the homes.
So what I'd like to do is just kind of take a moment right now and listen to a little bit of the press conference. So don't click off here because we're not listening to very much, but I want you to hear some key points.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate.
Now, for many of you, you really have no idea what that means. So, if you're not keeping up with it, how does that affect the overall economy by raising interest rates? You've already heard us say, Melissa was talking about, the 0.75% they did on Wednesday has doubled what they have done so far this year by their March and May meetings.
Raising rates makes borrowing more expensive and slows down major purchases. For example, credit cards, HELOCs, which is home equity line of credit, mortgages, student loan, and car loans.
Yeah, and it also affects the borrowing on large and small businesses, and many of the businesses where we shop, they finance inventory. In some cases, they have accounts receivable where they're waiting to get paid. So a lot of times they'll finance even things like payroll and, short-term loans and things like that. So these are companies that supply the bulk of consumers, you and me, with the products, the goods and services that we spend money on. So when this happens, what can we learn from what's happened historically when the Fed raises rates?
When the Fed raises rate, it instantly affects what we call prime rate. The prime rate is the interest rate the banks offer to their most creditworthy customers.
So the prime rate also affects other forms of consumer credit. In fact, it's known as high prime rate, and banks will actually raise that prime rate to borrowers that they find less creditworthy. So not just consumers, but also companies. So we have a link below from Investopedia that actually covers the impact of interest rates changed by the Federal Reserve. But essentially what we're saying here, guys, is that when the Fed raises the rate, ultimately it will affect you, especially on revolving credit and other types of debt that you have variable adjusted interest rates. So get your variable rate financing down as quickly as you can. Mm-hmm. Now, guys, we're not economists. We're not financial advisors. I'm a real estate broker. What I want to do now is I want to listen to what the Fed is saying about consumer spending.
Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply.
So the key takeaways are consumer consumption continues to be strong and the housing market is softening due to the rising interest rates.
One of the big concerns that I have with the Fed saying that consumer spending continues to be strong is that consumers are getting more and more in debt. So I'm kind of wondering, when we look at all this and we go, okay, consumer spending strong, so let's raise the interest rates because we want to curb inflation. But at the same time, let's take a look at the consumer debt. So here we go, guys. I got to put my glasses on for this one. But if we look at where we are right now today, and this is an interesting chart, also link is below. But if we take a look at this, so here we are, we're at June 1st, which obviously, a couple weeks ago, it shows you how many billions of US dollars of consumer loans are incurred right now. And that consists of credit cards and other revolving loans. And this is from all commercial banks. But if you take a look at this chart, I don't have to be an economist to see that we are at all-time level highs. And this kind of dates back, pre-2002. But you can see some of these spikes in 2010. Obviously, we know what happened then. We had the financial crisis, the housing market crash. You could see it just skyrocketed straight up consumer debt. And with it being much higher than it is or was back then, it kind of makes me wonder where we're going with this thing. And I think the Fed's pushing a recession.
What this is showing is that people are maxing out their credit cards, they're getting loans, and they're using all of the money that has been lent to them. So it is concerning.
And with the high cost of even just your bare necessities and groceries and things like that, I know the tendency is to put those on your credit card because, a lot of people, they get paid obviously weekly or biweekly, and some get paid monthly. So they're depending on the use of their revolving credit just to buy the basic necessities of fuel and groceries. And these are the things that we have to be really careful because if we don't pay those off, it's going to really cost us. Mm-hmm. Now, one of the things that I was concerned to hear Chairman Powell say was that with China's lockdowns, and this is just Wednesday, he said that, with China's lockdowns, that it could affect our supply chain even more. And we're just kind of getting back to some type of decent growth, stability. So let's take a look at what he says here.
Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions.
So the Fed's anticipating another breakdown in supply chain, at least the goods that we're getting from China. And a lot of companies here in the United States have factories in China. So they make certain things maybe here, but they rely on certain things from China. So this drastically affects the ability for them to assemble things. And we see this the most in the auto industry. The Fed also said that, there were rising energy costs, and we see that at the pump, but we're also going to see it, as our energy consumption increases as we go into fall and the winter if something isn't done. The Fed goes further into the effects of the Ukraine-Russian war, and also talks about how there isn't a whole lot that the Fed can do about the prices of that, as well as the volatility of the stock market.
It's definitely concerning knowing that there may be no end in sight for those rising gas prices and the supply chain disruptions.
I dropped a link below to the entire Powell press release. I highly recommend that you take the time to watch it. And then also, when he finishes his release, he takes questions from the reporters, and they're very interesting. What I want you to pay attention to and not give up at that point when you start hearing some redundancy in questions, because I want you to pay attention to the continual response that Chairman Powell delivers to each one of the questions. So let's listen to the expectations as the Fed moves forward throughout the rest of the year.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%.
In this segment, the key takeaways were the Fed had anticipated only raising the rate 0.5%. And then after reviewing everything economic-wise, they decided that it would have been a better decision for them to raise it to 0.75%.
And Chairman Powell goes on to say that they want to raise central banks' interest rate to 3.4% by the end of 22. And guys, that means right now we're sitting at 1.5%. So we're looking at the current rate more than doubling by the end of 22. Now, this time, I want to point your attention to the federal funds effective rate that in this chart dates back to 1955. And what we're going to see here is a couple things. One, you can see that really the Fed's effective rate in the last market crash, housing market crash back in December of 08 went down to 0.16%. And then it really stayed that way until we got into around 2015, where we started to see that this rate was increasing. And then it started to dip a little bit. And right before the pandemic was on its way down, trying to stimulate some growth. That's typically what they would do, is they would, lower the rate to stimulate some economic growth. And then basically what happened was when the pandemic hit, they dropped this rate to just about zero. And now we start to see that it's on its incline. Well, the other fact that this chart shows us that I'd like to point out is that it appears that the Fed, through the history of time, raises the interest rates to push or to bring on a recession. So these gray bars that you see represent a recession. This is also, this chart is linked below. You can pull it up, take a look at it in more depth yourself. But basically what we see is just about in every one of these recessions, the high of the Fed effective rate, the federal funds effective rate, peaked, there was a recession, and then they dipped down, sort of like to stimulate the economy. So I guess a lot of the question that everyone's asking right now, and you have to ask yourself is, is the Fed trying to push us into a recession by raising rates? And if so, are you prepared to survive through it?
You definitely can't ignore that data. It's right there. You can see the highs, the lows, exactly the points of the recession. It's going to be interesting to see what happens.
So interestingly enough, the Washington Post on Wednesday, ahead of the Fed's announcement, published an article, 7 Ways to Survive a Recession. I've linked it below. I highly recommend that you check it out, but I want to talk about 3 main takeaways of this article. And guys, like Melissa said, you can't ignore the data. We are spending, consumer financing is so high right now. We're spending a lot of money. We're coming off of record high inflation, 40, 50-year inflation levels. But the 3 main takeaways that the Washington Post, that I focused in on are to stockpile your savings, number 1. Number 2, get rid of your credit card debt or any revolving debt that has fluctuating interest rates, pay those down quickly. Again, I'm not a financial advisor. I'm not a credit advisor, but I know in the past, having credit card debt myself, I would focus on the ones with the highest interest rate, make sure you're doubling down on those, make sure you're paying your minimum payments. The last thing that you want right now is to damage your credit rating. And the third thing, which I thought was pretty cool, was to get a side gig. And, every one of us kind of can think about something that we could do on the side to make some extra cash. And with everybody right now, it seems like help wanted signs are everywhere. Get creative. You can probably make some extra cash for yourself.
You really need to establish stability for yourself.
And as far as the housing market, guys, I'm asked continuously, should I buy a house? I'm an investor. When do I know when the bottom is? I don't have the answers to all these questions. I can tell you, if you're looking to buy a house now to live in, you've heard me say it before. If you've listened to any of my videos, make sure that you're financially stable. Don't use all your cash to do so. Make sure you have emergency fund in the bank. And if you're planning on staying there for a while, ultimately we will recover. Even if we have a major downturn like we had in 2008, we've recovered from that. All things recover in time, and I truly believe that.
As always, we appreciate the support. Thank you for watching and tuning in. We love your comments and questions. Keep them coming.
And if you like this video, you can let Melissa and I know that you did by hitting that thumbs up. And we always appreciate it when you subscribe, hit the alert bell, and you'll be alerted every time we post important real estate updates. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.